Hi guys, a very good afternoon to all of you. Hope you all are keeping well. The preparation for exams is going well. So today we are actually going to discuss the pre-March mock that was released. I hope you all have done the pre-March or attempted the pre-March mock. And you're following the study plan that I had given you all. Yeah. Okay, let me assign. So all of you, please log into your ACCA practice platform. And in that, you scroll down to the SBR practice exams. There you'd have the SBR International Pre-March mock, Pre-March 2025 mock, which you have to assign. Once you've assigned that, I mean, this is for the ones who are doing mock for the first time or using the platform for the first time, which should not be the case with you all, yeah? Right. And then we start this exam. Okay. But just make a note, if you have not attempted this exam under exam conditions, please attempt it and then watch the recording, right? Because we are going to discuss and break down pre-March 2025 mock exam questions. So we'll see how many questions we can cover today. I'm trying to cover as many as possible. If all would be possible, brilliant. Not as many as possible. And we'll see if there is a need. I might take one extra session to cover the remaining questions. All right. So this is how your practice platform looks like. Very similar to your actual exam platform. So you're making yourself familiar to this entire practice platform is going to be handy to you to go to the exam, not be surprised with surprises. Yeah, although there might be surprises, but if you are familiar with the mock versions of surprises, you will not be surprised. All right. So all the exams, past papers, or any questions that are attempting, you're supposed to attempt it on the practice platform. Okay. So as usual, SBR has two parts, section A and section B. Section A has two questions. First question that would have pre-populated spreadsheet, which carries 30 marks. And then the second question, which focuses on ethics, will carry 20 marks. So 50 marks for section A, 50 marks for section B. 30, 20, then 25 each in the section B questions. So remember, the second question also carries professional skills marks, or PSM that you call. 2 marks of professional skills marks you're going to get through the second question, which would be given to you based on the structure of your answer as well as the clarity that you bring in, right? And the requirements that you fulfill, right? Structure, clarity, requirements. 3 things that you need to be very particular about when it comes to the PSMs, or professional skills marks. All right. So generally, what is the best way to approach any exam questions or any exam papers is that you always take down the requirements first, right? First you take down the requirements on the answer sheet, right? So here we are going to use word processor. But before you read out the question, you go to your requirements. Just copy these requirements down, copy them down, go to your word processor, paste the requirements. Maybe you can do this when you have the 15 minutes of reading time, so you can structure your answers accordingly. Okay. So section A, section B, section C. Okay, so there are 3 requirements. So requirement A, requirement B, and requirement C. Okay. Now requirement A says using exhibit 1, right? So you highlight that. So you need to know when they are specifically asking you to use a particular exhibit, you're not supposed to use any other exhibit. So you highlight what is important. And in accordance with IFRS accounting standards, explain with calculations how to. So we'll quickly highlight what are the requirements. Explanation with calculations how to correct the treatment of Gamba Co. in the consolidated financial statements for the year ended 31st December 2027. Now, remember, first question is mostly going to be focusing on, not mostly, all the time it's going to be focusing on the group accounting, right? The errors that are made in the consolidated statement of financial position or consolidated statement of profit or loss, and you will have to correct them as well. Yeah. So using Exhibit 1 and in accordance with IFRS accounting standards, explain with calculations how to correct the treatment of Gamba Co. in the consolidated financial statements for the year ended 31st December 2027. That's a requirement 1, carries 11 marks, right? 11 marks, meaning 60% is going to be for the explanation, 40% for the calculation. Usually that's what we work towards. So you should know 7 marks are going to be for explanation, 4 marks are going to be for calculations, right? So you need to break down your explanations accordingly. When it comes to explanation, as I always say, knowledge plus application is important. So you need to apply your knowledge there. I mean, you need to bring out the knowledge from whatever the standard that you are dealing with, and you apply that knowledge with the scenario. Now, knowledge doesn't mean that you bring everything in the standard down. That is not relevant to scenario also. Knowledge meaning relevant areas from the standard or the content you bring down, you show your knowledge on those specific and relevant areas to the scenario. Then you should be applying those. Whatever knowledge you are bringing in, you should be in a position to apply them. Very important. Okay. So 7 marks for explanation, calculation, 4 marks. So in this way, you need to respond to all these questions. Let me just verify how many marks do we have once again. Yeah, so it's 11 marks where you will have to bring in calculation and the discussion. So both the elements are important here. And whatever calculation you're doing here, remember it is going to be relevant to the pre-populated spreadsheet. All right. Okay, so that's requirement number 1. Explain, discuss, or calculations. Right? So whatever the problems are, so ideally how you break it down is problem 1, explain with calculations, right? Then problem 2, explain with calculation. So this is a format that you can follow. Always you bring out all the issues, or rather than problem, will change this to issue. Issue 1 and issue 2. Right? So issue 1, you explain what the first issue you are going to discuss about, and what is the problem here and how you correct it. Right? So here you're supposed to correct it. Right? So issue 1 meaning what's the first problem, or what's the first issue that you see in the scenario. Then you bring the actual calculation, then you compare it with the calculation that's given and you correct it. Okay? The requirement is correction. Right? The requirement here also is the correction. What is going to be the correction for issue 2? And likewise, the issues, how many issues are there? You have to touch upon all those issues. Okay. Now, explaining this practice platform, I'm not going to do the answer here. We are going back to Word and Excel as usual. But I'm using this just to give you an idea how to structure your answers. Okay. Right, the second requirement, or requirement B, asks you specifically to use Exhibit B. Right? Again, now this is Gamba, just to make a note of that also. So there are 2 issues that they're speaking about. The Exhibit 1 speaks about Gamba Co. Exhibit 2 speaks about Sales Co. Again, correction is required. right? Since they are requiring you to explain with IFRS accounting standard, always remember whatever you explain, explanation will require relevant knowledge plus application. Explanation is relevant knowledge plus application. Also, guys, don't worry about your spellings as far as it is understandable, readable. You don't have to go back and correct spelling mistakes. If there are spelling mistakes, just go ahead. Right? Don't go back and correct the spellings and all that. And when it comes to pre-populated spreadsheet, the tip that I gave you last time also, don't go to provide the final values. That's not important. As far as you know that every area that you're correcting is balancing, meaning the end is definitely going to balance, right? Your debit should equal to your credit. So assets should equal to your capital plus liabilities. If that is happening, at every correction, you don't need to actually go and show the revised. The revised figures are not going to get you any marks, right? So you don't do that. So explanation, relevant knowledge plus applications. Relevant knowledge meaning this might mean application or standard content requirement based on the scenario. Okay, based on scenario, and then the application to the scenario. Application of what? Application of the knowledge. Application of knowledge to the scenario. Okay, right. Then using exhibit 2, you need to show how to correct the treatment of salary score. It's 5 marks. So here again, we are looking at a 60-40 approach. So 60-40 would mean 3 and 2, right? So you might be in a position to get 3 marks for explanation, 2 marks for calculation and correction. All right. So that's something you need to remember here. And final, requirement C says using exhibits 1 and 2 and your previous answers, adjust the pre-populated spreadsheet response to correct the draft consolidated statement of financial position. So they've given draft consolidated statement of financial position. This carries 14 marks. Now this is purely math. Now here you should be very particular about plus and minuses. Whatever workings you've done, you are accumulating. If you've done it right here, these 14 marks will be free marks. It's just a matter of going and plugging into the right areas and using the pre-populated spreadsheet correctly. Okay, so that's the key. You identify all the issues, and whatever issues are identified, that's what you have to go and correct, right? You have identified the correction here. You have to go and just plug in those numbers. So these 14 marks would be free for you had you done a good job in 16 marks, right, in your section or requirement A and requirement B. If you complete that with precision, just a matter of going and plugging your answers or corrections in section or requirement C or your pre-populated spreadsheet. Okay, it's purely based on the calculation and correction done in requirement A and B, which means if you have attempted A and B with precision, this would be easy marks. Pick and plug approach here. So always remember, whenever you are doing this, now here I'm just giving you tips, and these are not the answers yet, right? So we're not discussing answers yet. We'll be starting to discuss the answers. So picking and plugging, you don't go to do it separately. That's another key point that you should keep in mind. Whenever you are attempting section A or requirement A and requirement B, keep your spreadsheet open as well, right? And as you are correcting, now here you need to put the issue names. So here, since we don't have, I have not identified yet, I'm just going with issue 1, issue 2, right? And guys, remember, if you all delete whatever is given here, whatever the spreadsheet is given, if you go and delete it, you can't go, it does not come back. So don't touch that area. Whatever they've given, don't touch that. Let it be as it is. You just work on the empty cells. Don't go to delete any figures there. right? Issue 1, what's the case with that? Then issue 2, issue 3. So you have already made the corrections. You have to, as you made the correction, explain issue 1, explain, you know the correction, you come and quickly plug it here. Issue 2, you made the correction, quickly come and plug it here. Issue 3, you made the correction, quickly come and plug it here. Okay? So do it together. So if you do it together, that's a good way to manage your time as well. Otherwise, you will struggle to manage your time because you are duplicating your work. You've already done in section A and say requirement A, requirement B. Now requirement C, you have to go back, read requirement A every time to come and do the requirement C. While, because you would have forgotten, right, exactly all the points that you did, and you can't do everything together. So you have to go and refer to all the issues and come and do the correction. So if you do it together, issue 1, explain the calculation done, quickly come to the spreadsheet, do the correction. Issue 2, explanation done, calculation done, there you know the correction, quickly come to the spreadsheet and do it here. Okay, so in that way you'll be able to manage your time very clearly. So as I told you, if you do your requirement A and requirement B with precision, requirement C is going to get you easy marks. All right, so that's key. If you are able to crack this question, meaning you are halfway there. Okay, clear? Right, just give me a moment. Let me quickly bring the Word and the Excel that I have prepared. Because the reason I'm doing it on Word and Excel is so that I can explain while I'm doing it. Okay? And that will be more impactful to you all as well. All right. Okay? Right. So as I'm doing the explanation or as I'm explaining, please keep an eye here. All right? Okay, so now let's start reading the requirements, right? You can open these exhibits and you can start reading the question and the exhibits. Okay, but the Word that I've done, I've already put all the exhibits there. So I'm going to refer to my Word document now. So what you all are supposed to do, use the practice platform itself. All right. There we go. There we go. That's my Word. And then this is my Excel. Right? This is my pre-populated spreadsheet on my Excel. Okay. Right. Let's start reading. Question 1. Enriquez Co. is the parent company. Identify who the parent is. Enriquez is the parent of a group which prepares financial statements using IFRS accounting standards. The financial year end is 31st December 2007. Important elements, just highlight them. Following exhibits available on the left hand side of the screen provide information relevant to the question. Acquisition, share sale, and then draft SOFP. So exhibit 1 is acquisition. Exhibit 2 is share sale. Exhibit 3 is the pre-populated spreadsheet or draft SOFP. Okay. Right. So our first requirement or requirement A asked us to use exhibit 1. Right? Exhibit 1 where to explain and calculate. Okay. Right. Let's start reading. On 1st January 2007, 1st January, when is the year end? 31st December 2007. So first, it's 1 year. It's been 1 full year, right? 1st January 2007, Enriquez Co. acquired 60% of the equity share capital of Gamba Co. 60%, more than 50%. The consideration transferred by Enriquez Co. was 50 million cash. Enriquez Co. must also make a further payment of 35 million on 31st December 2018, but no accounting entries have been recognized in relation to this. Okay, there we see the first problem, first issue, or first error. We identified that, right? What is this? 35 million on 31st December 2018. 1st January 2087 is where the acquisition happened. So 2087 1 year, 2088 2 year. End of the second year is where you are making the payment. So that makes it a deferred consideration. That's a deferred consideration, and they are saying no accounting entries have been made, meaning that has been completely eliminated. So that's the issue number 1. Okay, let me highlight this. Issue number 1. All right. Then the next, let's read further. The carrying amount of Gamba Co.'s net assets in its individual financial statements at the acquisition date was 80 million. 80 million, right? Important key information. Why? To calculate a goodwill. Included in the net assets at acquisition was a factory building with a carrying amount of 10 million, a fair value of 40 million. Fair value. And remaining useful life for 15 years. The tax base of the building in its carrying amount in the individual financial statements. Tax base of the building is its carrying amount, meaning tax base also has been, whatever tax calculation also has been based on 10 million. All right. Okay. The tax rate in jurisdiction is 20%. Key information. The net assets of Gamba Co. have been included in the draft consolidated statement of financial position, meaning your exhibit 3, where they've given the draft statement of financial position, at their carrying amounts. Issue number 2. What does IFRS 3 say? IFRS 3 business combination, what does it say? It says that you need to carry your net assets at their fair value and not their carrying amount. But what have they done here? They've used carrying amount. Tax base again on carrying amount. Right? So there needs to be fair value uplift, fair value enhancement, or fair value adjustment. That's issue number 2. All right. But issue number 2 includes issue number 3 as well. Right? Issue number 2 is, let's say, PPE, fair value adjustment. Issue number 3, within this case itself, is the deferred tax. Okay? Issue number 1 is deferred consideration. Okay? Deferred tax is also there. Then read further. It is group policy. It is group policy to measure the non-controlling interest at acquisition at its proportionate share of the fair value of subsidiaries' identifiable net assets. Proportionate share of the fair value of subsidiaries' identifiable net assets. That's the issue number 3. Okay. Proportionate method is what they're using. Now, what does that mean? Had they done the calculation, they would have done the calculation at carrying amount as well. Right? Net identifiable assets at carrying amount. Based on that, they've calculated the NCI. Another problem. That's the issue number 4. Right? Goodwill arising on the acquisition of Gamba Co. has been measured and recognized at 32 million in the draft consolidated statement of financial position. Right? I mean, 32 million is what they have taken, right, as the identifiable net assets base proportionate share for NCI. That's the issue number 4. Okay, that's the issue number 4. All right. Okay. Now, if you do the calculation math also, this 32 million is the 40% of 80. That's how they've arrived at 32. Okay, but what is the actual issue? They have not considered the fair value adjustment or the deferred tax implication there. Right? Deferred tax implication impacts the liability, and fair value of a liability also needs to be considered for a goodwill calculation. Right? That means this entire calculation of goodwill also is wrong. So when we are calculating, you have to provide revised goodwill calculation. Revised goodwill calculation, and then they're saying a discount rate of 5%. The discount rate of 5% should be used when required. Why do we need discount rate? Why do we need discount? There 5%, 20% is given for the tax. Discount rate is required for deferred consideration as well as unwinding of the discount, because these at the year end there is subsequent treatment also. For those two elements you need this 5%. All right. Okay. The mock is not that difficult. It's pretty straightforward. If you have really understood the entire group accounting properly, this is not going to be difficult for you all. You can do this. All right. It's pretty straightforward because we can identify it then and there. Yes, if we know it exactly, we can correct all of them at once. Right? That's exhibit number 1. Now we've read exhibit 1. We are good to respond to the requirement 1. Okay. We are good to respond to requirement 1. Right. Right. You're supposed to use exhibit number 1 and calculate and correct errors. Okay. All right. So as I always iterate, knowledge and application is very important. How do you structure this? Issue number 1. What was the issue number 1 that we identified? Deferred consideration. Right, deferred consideration. That's the issue number 1. Okay. Right, now we bring in the knowledge element. Knowledge element that is going to be relevant. Okay. What's the standard? IFRS 3. What does IFRS 3 say about deferred consideration? What does IFRS 3 say? Right, it says consideration transferred to acquire subsidiary should be at fair value. Okay, that's how you apply knowledge. So I'm not going to do it for everything. So this is just a structure I'm giving you all how you can crack the knowledge part, right? So you say IFRS 3 says consideration transfer to acquire subsidiary should be at the fair value. Okay, therefore deferred consideration that will be paid at a future date should be measured at fair value. Right? That's a knowledge part. That's a knowledge part. Right? Then there is going to be the application. Then comes the application. Okay, then comes the application. So what's the deferred consideration here? So you bring in the, how do you apply to scenario? You bring in the name of the company. Enricus Co. has acquired the control in the subsidiary by transferring cash consideration as well as consideration that is to be transferred two years later at on 31st of December X8, right, with a value of 35 million. All right, application. Since, so I'm not going to write this formal answer for every requirement. This is I'm writing for you to get an idea. The rest I'll be explaining. All right, right? Since the payment is at a future date, the present value calculation using the appropriate discount rate should be performed, should be done. In this case, at 5%. Right? So that's the application. Okay? Now you quickly do that calculation and show. Calculation. Now this is still the issue number 1. Okay? Calculation. Okay, this color does not sit well. So calculation is going to be 35 million into 1 over 1.05 to the power 2, right? This is the discount rate and that's the number of years. In how many years we are going to pay this, right? This equals to 31.7 million. Okay? Then the application continues. Goodwill needs to be increased by 31.7 million and a corresponding credit should be done to liability. All right, corresponding credit should be done to the liability. All right, so that's point number 1 in issue number 1, right? Still continuing with issue number 1, when there is a discounting factor done, right, we have to unwind. When the amount is discounted to the present value, subsequently the discount needs to be unwound by the discount rate until the settlement happens. Again, you see a knowledge component that we are bringing in. Then we are applying it here. In this case, discount will be unwound by 31.7 million into 5%, which is going to be 1.6 million, right? This will be debited to P&L finance cost and will increase the liability. Okay, so how many calculations have we done here? Okay, now this answer might be too long for requirement. I mean, if you are to at the exam setup, you don't need to give the answer in so much of detail. But why I'm giving you the answer in so much of detail, so that you understand how to approach knowledge element, how to approach the application element. All right, but you always need to focus on keeping your answers crisp and concise and to the point, right? I'm giving this to explain to you all what actually has happened with that issue, right? Okay. Now, when this happens, you need to know when whatever is going to impact. Now, this is out of, now this is the requirement 1 fulfilled. Okay. Requirement 1 fulfilled. What you need to remember here, any amounts impacting consolidated statement of profit or loss should be attributed to both parent and NCI in consolidated statement of financial position. Now, why is that important? To correct our, what do you call, the pre-populated spreadsheet. Okay, that is needed to correct our pre-populated spreadsheet. Now we can, now as we are done with the discount, the issue 1, we can directly go and deal with a pre-populated spreadsheet as well. Okay, because we know what the first issue is. First issue is deferred consideration. Right? So what is going to be the deferred consideration double entry? Deferred consideration double entry is going to be goodwill. Your goodwill is going to be debited. Debit your goodwill, meaning you increase your goodwill by 31.7 million. We got this amount from our calculation. And deferred, here the current. Okay, now at the end, we are doing it as at the end, 31st of December 20x7. We are to pay by 31st of December 20x8, meaning within a year we are supposed to pay. So that becomes a current liability. Okay. So our current liability is increased by 31.7 million. Now we know that debit equals credit. So that is correct. So this is going to balance so far. All right. This is going to balance so far. Even if you all want, you all can do the working on the Excel deferred. So you can do the working in Excel and you can bring only the figures to your explanation. I mean, explanation we could not do the working, no? Right? Okay. In the Excel, in the explanation that we just did, if you look at this explanation, in the explanation we have not done the working. We've just shown the formula and we've just given the figure. But you can always do the working, then bring the formula and figure. That would ensure that your figures are correct. Now here I know the figures, so I've brought it. I'm using a calculator, I can calculate that. Now here you can do the working as well, right? You can do it as working 1, or you can directly, since you have to do the revision of goodwill, working 1 can also be goodwill, right? Goodwill correction. Okay. Now to do this, we know there's a cash consideration of 50, that is correct. Now we have deferred consideration. Deferred consideration of 35 million into 1 divided by 1 into the discount rate to the power number of years. There we go. That's a deferred consideration, 31.7 million. You can either do it as separate working, or you can do it as one working for goodwill, revised goodwill or goodwill correction. All right. If you are showing working 1 as deferred consideration, there you can show within that working, you can show the unwinding also. Okay. Right. So this also gives rise, this working 1 itself gives rise to unwinding as well. Right. Now let's do, or we can even do a sub workings, right? Sub working or working 1.1, 1.2. It depends. However you all do the working, it's fine, right? So let's do it as working 2. I'll use W. You can use W instead of full. Unwinding cost, right? How would the unwinding happen? 31.7 million into 5%. That's our unwinding cost, right? So we round it out to 1.6. Okay. We round it off to 1.6. There we go. All right. Now this, how are we going to do the adjustment? We know that unwinding cost is going to increase our liability. So there we go and do the 1.6 increasing the liability plus there. How is it going to impact our consolidated statement of profit or loss? Consolidated statement of profit or loss is going to reduce the profit, meaning it's an expense. Expense reduces the profit. Reducing the profit means retained earnings reduces, right? But retained earning component is for parent, and such a component for NCI will be recorded under NCI. So we are going to deduct from retained earnings this multiplied by 0.6. Multiplied by 0.6, right? 60%, right? 60% is the amount. Yeah, so we are reducing this from retained earnings. Right? Okay. Then we have the issue number 2. Right. Issue number 2. Okay. Right, just a quick correction. This 1.6 is not going to impact the NCI. Why? Because this is the parent that is paying the consideration. Okay, deferred consideration is paid by the parent, so it is just going to impact the parent. All right. So that completely goes out of retained earnings, and there is no proportionate there. But anything that impacts both parent and retained, the NCI, there will be doing the proportionate adjustment. That's unwinding cost. Okay, that's unwinding cost. What happens? Debit our expense and finance cost and credit our current liability. So that is going to be our issue 1, the correction of issue 1. Now we go and do the issue 2. Clear? Issue 1 is about deferred consideration. Now we can discuss the issue number 2. Yeah. What's issue number 2? We already went here and identified the issue number 2 as well. What is issue 2? PP fair value adjustment. Issue 3 is deferred tax. Right. This is PPE fair value adjustment. Okay, that's the issue number 2. Right? Or even if you want, you can actually deal with it under the term net assets, right? But let's use a PP fair value adjustment as issue number 2. Yeah? Okay. Now again, I'll give a quick explanation on the knowledge part. What does the knowledge say? Knowledge says that identifiable net asset at acquisition should be at fair value. Right? At fair value. Now we have to bring the application. What's the application here? The application here is that subsidiaries PPE has been recorded or recognized at their carrying amount. Right? Carrying amount of 10 million. But it needs to be recognized at fair value of 40 million. Right? Therefore, calculation element comes in. Therefore, fair value adjustment of 40 minus 10, 30 million will need to be done. Okay, 30 million will need to be done. This will, what will this do? This will increase the PPE and reduce the goodwill. Okay, increase the PPE and reduce the goodwill. Quick, so I'm just changing color so you remember when I'm doing knowledge, I'm using purple, application, I'm using black, and calculation, I'll use green. Okay, right. Then subsequently, fair value adjustment needs to be depreciated, or excess fair value needs to be depreciated over its remaining useful life. Application. This will give an excess depreciation of 30 million over its remaining useful life. What's the remaining useful life here? Remaining useful life. Okay, remaining useful, they've given here 15 years. Okay, that's why highlighting these are very important. Okay, remaining useful life of 15 years. 30 million over 15 years, which is 2 million. And this will impact the PPE and consolidated statement of profit or loss expense, which will be attributable to parent and NCI. Okay, so now we know that it's 2 million, which is the fair value adjustment and the excess depreciation on fair value adjustments. That's issue number 2. Again, issue number 2 is bringing us 2 areas that we need to focus on in our consolidated statement of financial position. There we go. We have more corrections to be made. Fair value adjustment. What happens with fair value adjustment? Our PPE increases. PPE increases by 30 million. And our goodwill will reduce by 30 million. Why? Because net assets will be reduced when calculating goodwill. Right? So identifiable net assets. We'll quickly make a point of identifiable net assets. So we can do all the workings at once itself. Okay? Fair value. So fair value adjustment of 30 million. Okay, 30 million. Let's push this by one column. 31 equals 35 into, I'll just do that working once again so that we can have space to note down all the identifiable net assets clearly. 5 to the power 2. Right. Unwinding cost is going to be this into 0.005. There we go. Right? Fair value adjustment of 30. That's also impacting goodwill. So we are revising the goodwill also alongside working on other areas. Right? Then the next correction that we need to make is the excess depreciation. Excess depreciation. Right? So how does the excess depreciation work? That's going to reduce our PPE, credit our PPE by 2 million, and that is going to impact our retained earnings and NCA. Now at this point it's impacting both, okay, because it is a fair value adjustment there. That's going to be this multiplied by 0.6, 1.2 for retained earnings, and this multiplied by 0.4. That's going to be for NCI. Okay, that's going to be for NCI. Clear? Then let's move to the next issue. Issue number 3 is deferred tax. Issue number 4 is NCI. Right? Issue number 3 is deferred tax. Let's quickly move to issue number. Right. So the knowledge part that you bring in here, when the accounting profit and tax base are not equal, this gives rise to temporary differences. Which will need deferred tax adjustment. Application in the fair value adjustment due to subsidiaries PPE creates a temporary difference. Temporary difference that is taxable, right, in the consolidated financial statements. A deferred tax liability at acquisition will be calculated based on the difference at the tax rate in the jurisdiction, which in this case is 20%. Okay, which in this case is 20%. Therefore, a deferred tax liability of 30 million into 20%, which is 6 million, should be recognized at acquisition. This will increase the goodwill. Why? Fair value of identifiable net assets includes fair value of liabilities. That's in the brackets. That's for explanation purpose, right? So that's going to increase the goodwill, and it is also increasing the deferred tax liability. Okay, we've already told it's increasing liability. So again, we are repeating that. So be mindful of not repeating, right? Okay. So now this adjustment also we can now go and do that. We have the deferred tax adjustment here. Okay. Deferred tax will increase our goodwill. Why? Because that's reducing unidentifiable net assets, right? So when that reduces the identifiable net assets, that increases goodwill. So you need to have that in mind. 6 million, and this also is going to increase my deferred tax liability. That's a deferred tax liability by 6 million, right? And that also will reduce my goodwill. Let's say I'm doing all these adjustments together, explaining each issue, correcting the pre-populated, doing the revised goodwill calculation. So all of that I'm doing together. So that will actually help me save time. Okay. Again, time, how are you going to decide on time? 1.8 minutes per mark into the number of marks. 30 marks into 1.8. You are not supposed to spend more than an hour there. Right? Around 50 minutes is what you can spend on this question. Right? But I might take a little bit more time because I'm explaining in detail. You are not supposed to take that much of time. All right? Okay. Now this deferred tax itself, there is further issue to identify. Now deferred tax increases and reduces, right? Every year it increases and reduces depending on the temporary difference change, right? So again there is subsequent change here. Right, there is a subsequent change here. Subsequently, the temporary difference will reduce by depreciation amount or accumulated depreciation amount, and therefore the deferred tax liability will need to be recalculated at the year end and adjusted. In this case, 30 minus 2 equals 28. 28 is a new temporary difference. Into 20% is going to be the new deferred tax, 5.6 million, which means reduction of 0.4. How? 0.4 how? 6 minus 5.6 is 0.4 million. Clear? So now we can do that adjustment also. Because we're doing it at the year end, we have to make all those adjustments. Reduction in deferred tax. So when there's reduction in deferred tax, what happens? What are the areas that are being implication is going to be where? What are the areas where we'll be seeing the implication of the reduction? So that's going to impact our deferred tax. Give me a moment. Just want to make sure it's in the correct column. See, it's in the wrong column. 6. Right, so implication reduces this by 0.4. So that's the debit part. What's the credit? What's the credit here? It's going to reduce our income tax expenses. How is income tax expense calculated as per IAS 12? We have the income tax estimate for the year plus or minus change in deferred tax. Deferred tax goes up, it increases the tax. Goes down, decreases the tax. Right? And there's a the provision, over provision, under provision, that's different. But here deferred tax is important. So deferred tax reduction is going to reduce our tax, income tax. Now income tax is also going to impact both retail parent and NCI. So that's also going to be attributed to both parent and NCI accordingly, right, based on their percentage. Into 0.6 will be for the parent, into 0.4 will be for the NCI. Okay, this is going to increase. So when the tax reduces, profit increases, right? So there we have to make a small that's a positive figure. Why? Because when the tax reduces, that means that my profit increases. Okay, so I have a profit of 0.4 increase. All right, the net profit. That's the next adjustment. So that's not going to impact the goodwill calculation. But the goodwill calculation, it's the acquisition part that's impacting here. So we're not going to do any change or we're not going to touch that there. Okay, and the working that we showed there, you can even show here as workings and calculate and bring that working there. But you can do it on that platform itself. But make sure you'll show the formulas and numbers, everything on the Word also. Right, just doing working is not sufficient. So doing it there is the best. Right. Okay, then we have the final issue that we had identified, which is NCI, correct? Yeah, NCI acquisition measurement. So NCI was measured at 80, right? 80 was where it was measured. Why? Because 80 was a net assets carrying amount. But carrying amount of fair value was different, so we made that change. So let's go and quickly record the carrying amount of the identifiable net assets. Carrying amount was 80. Right, so that gives us our identifiable net assets plus 104. That is our identifiable net assets, not 80. What has happened? They had used 80 and calculated NCI here. So NCI was 80 into 40%. Well, it's actually supposed to be 104 into 40%. All right. So we have the NCI figure, so we can calculate that, but let's go and do the issue discussion and come back and do the calculation. All right. Then the final issue number. Right, NCI acquisition is the issue number 4. Okay. Right. Now here, the knowledge part that you can bring in, NCI measured at the proportion of identifiable fair value of identifiable net assets needs to be based on the correct value of identifiable net assets fair value. Application. In this case, NCI was measured at the carrying amount of the identifiable net assets and not fair value. After fair value adjustment and deferred tax adjustment, the fair value of NCI, fair value of net assets, has increased to $104 million. Okay, $104 million. How? 80 plus 30 minus 6. Okay, $104 million. Therefore, the NCIs at acquisition now would be 104 million multiplied by 40%. That is how much? 41.6 million. And the increase needs to be adjusted, which is 41.6 minus 32. Right, 41.6 minus 32, which is 9.6 million. All right, that's issue number 4. Now let's go and do the working quickly. Now we know this is going to be 104 into 0.4 at 41.6. So what's our total consideration plus our total investment amount, fair value of the investment, and that gives us a corrected goodwill as well. So we have completed a goodwill working. We have our corrected goodwill figure. Right, that's our corrected goodwill. Okay, 19 point. Now we can even cross check whether we've done it right by checking the component of the total of goodwill line. Right, so what are the adjustments we're supposed to make here? NCI adjustment, NCI, which is going to increase by 9.6. So that is going to increase our NCI, increasing our goodwill by 9.6, and it increases our NCI by 9.6. Okay, that increases the NCI by 9.6. So that is the detailed response for our requirement A. Okay, so that's a requirement A. What's important? To have a detailed understanding about the entire syllabus, all the standards, the entire content. Only if you have all that detailed understanding, you will be able to respond with precision. And when you are able to respond with precision, that is going to give you easy marks. What did I do here? What did I do here? I was responding to the requirements. Then I was also, alongside that, I was responding to the pre-populated spreadsheet. Alongside that, I was also correcting my goodwill. I was revising my goodwill. I did all of those together. Okay, I did all of those together. Clear? That's how my exhibit 1 worked. So we have complete exhibit 1 and most of exhibit 3 as well. Right, now there's exhibit 2 that we need to read, and we need to respond to that exhibit accordingly. All right, let's quickly read the, now that's a smaller exhibit with the lower little marks that you're getting there. So the requirement here was using exhibit 2 in accordance with IFRS accounting standards, explain calculations again, how the correct treatment of sales score in consolidated financial statements for the year ended 31st December 2007. So correction, 5 marks there. Okay, sales score. Right, now we are starting our requirement B. Right, sales score. Now let's quickly go and read the exhibit and come back and do the answers. Right. Several years ago, Enriquez Co. purchased 75% of the equity shares of Salesco. Several years ago. 75% shares of Salesco. On 31st December 2007, Enriquez Co. sold 10%, right? There's a sales happening, of the equity shares of Sales. Okay, now that's a part disposal, right? Not a complete disposal, a part disposal. 75% to 65%. So this is control to control scenario. Control is not gone yet, right? This reduced its holding to 65%, but meant that control over Salesco was retained. They are clearly saying also it was retained. Cash proceeds of $22 million were received from the sale. 22 million was the cash proceeds from the sale, with the other side of the accounting entry being recognized as other income in the consolidated statement of profit or loss. No other accounting entries have been recognized in respect of the share sale. No other accounting entries have been recognized. Okay, so they have done the other side, which is other income, but there is nothing else that they've done, right? But are we supposed to recognize the other income? When it comes to control scenario, just think, do we recognize it as a sales? No, right? So we don't recognize any gain, loss, right? Even control remains. The only change that we do here is going to be the NCI change. So NCI, just like the control has gone down from 75 to 65, NCI has increased from 25 to 35%. That's your NCI adjustment. Okay, so you have to, that's a wrong entry that you have to correct. The net assets of Salesco in its individual financial statements were carried at 146 million on 31st December 2007. Salesco owned land which had a carrying amount in its individual financial statement 6 million at the acquisition date, but a fair value of 18 million. Right, they've given that information for goodwill purposes, but since it's controlled, if it was not controlled to non-controlled, goodwill also should have been eliminated, but here goodwill also is retained, no gain or loss record. Okay, no gain or loss recorded. So goodwill not recalculated, no gain or loss arises, and 22 million that has been recognized as income, you need to remove that to eliminate that, right? And this needs to be accounted in equity as increase to the NCI. That's what is happening here. Okay, that's what is happening here. So we can use the information that's given here, 146, then they've given the 18, right? Then they've given the 6, right? So this is the fair value adjustment. So 18 minus 6 plus 146 will give us our net assets. So we would know what were the net assets that they were having at that date. So that you can multiply by the percentage that's increasing and allocate that to the NCI. Okay, that's what happens here. Requirement B. How are you going to explain this? Knowledge. IFRS 10 and IFRS 3 are the standards in focus. Disposal part of shares in subsidiary as per the standard. If it is, you explain, that's knowledge, you have to assess whether it's control retained or not. Then if control to control scenario, no goodwill recalculation, no gain or loss arises on this transaction. Only NCI adjustment is necessary to increase the NCI portion of investment. That's the knowledge part. Then you apply that application. In case of Salesco, Enricus retains control as they hold 65% of shares in Salesco after disposal. The reduction of 10% in ownership will increase the NCI, the non-controlling interest, by 10% to 35%. By 10%, meaning 25 becomes 35%, right? And therefore, NCI adjustment is necessary. Since there has been no loss of control, any gains or losses recognized needs to be removed, which in this case is 22 million recognized in other income. Right, with that we apply the knowledge to the scenario, and now we do the calculation. So calculation, what do you do? How do you do the calculation? First you are going to recalculate your NCI, right? Now how do you do that? First you have to Identify at the date of share sale, at the date of share sale, net assets of Salesco. What were components of net assets here? We saw there was 146 million, if I'm not mistaken. Go back. Right, so 146 million is the carrying amount, right? Net assets carrying amount. Then there is a fair value adjustment, right? Carrying amount. Fair value adjustment of 18 minus 6, right? So 18 minus 6, what's going to be fair value adjustment? 12. So that brings us to 158 million, right? Now what you do, the NCI or recalculated NCI is what you call it, adjusted NCI will increase by 10% of 158 million, which is 15.8 million, right? That's the NCI increase, right? By 10%, that's the increase in NCI. Okay, the difference between the proceeds, we have 22 million that we have to remove, right? Proceeds received and the NCI is minus 15.8, which is 6.2 million, right? This is recognized as under other components of equity increase. That's what we are explaining. That's it. Now we have to go and do the final adjustment on our pre-populated spreadsheet. With that, we complete our response. Right, so pre-populated spreadsheet, share sale, we have to ensure that we increase the NCI by 15.8 million. Right, this is the NCI here. This is the NCI 15.8. Then we have to remove the 22 from income. So removing the income meaning it reduces profit, reducing profit meaning reducing retained earnings, reduce retained earnings by 22, and other components of equity is where you'll be recognizing the difference, right? 6 point. So that is 15.8. Okay. And now we are good to check. I am checking. You don't go do the revised amounts. I'm just doing it for the purpose of checking to ensure if everything is matching and what are the updated figures. But you are not supposed to do that in your exam. You're not going to get any marks by doing that. Revised. What's going to be the revised amount? We know the draft amount. Now we are going to do the revised amount. Okay. No adjustment here, remains as it is. These are goodwill adjustment. We'll see if this is matching with our goodwill calculation. We have recalculated goodwill. Is that matching our goodwill? 140.3. Right, so what's the increase? This minus 17.3. Right, there is some correction required. 31.7. 136, 40. Yes. Yeah. Because goodwill initially was 2. So 17.3. Now it becomes 19.3. So difference between goodwill, initially recognized goodwill was 2. Now it was 19.3. So difference of 17.3 is adjusted here. All right. Balances. Then there is current assets. No any changes there. So we take it as it is. Then we are good to calculate our total assets. Good to calculate total assets. Okay. Then we calculate our equity plus liabilities. $209.44, 196, 0.8, 0.16, 9.68. Okay. Then comes the liabilities. Balancing. There we go. So with that, we conclude our question number 1. Right? Pre-mock question number 1, we are done. All right. So again, feel free to do the working in the ways that you all want to. If you all want to show clear workings for separate items, do the workings, but make sure when you're explaining, you bring the workings here also. These are all supposed to be typed. Why I have written for clarity purposes, but you are supposed to type it. And all the workings that we've brought in here, you see, I've just not given the figure. I've also brought the workings in. So you need to, why I've brought the workings in, to show you that we need to bring the workings and we need to show how we have arrived at the value that we are arriving at. Okay, so workings are very, very important. So how do you respond to these questions? First, you apply the knowledge, relevant knowledge, then you apply that knowledge to scenario, and then you do the calculation and correction. And once you adjust it here, you go and quickly adjust a pre-populated spreadsheet and whatever else that's required. In this case, we have to revise the goodwill, do those calculations together. When you do it together, you'll be able to save time and you'll be able to respond to the question in a quicker manner and gain all the easy pass scores in the exhibit 3, or the pre-populated spreadsheet. Keep in mind the own figure rule. There is something called own figure rule that you are getting. Now let's say you have calculated wrong temporary difference. Now based on that figure, you will be calculating at applying 20% and arriving at the correct deferred tax liability on that own figure rule. So you will be deducted, the marks will be deducted only at the figure that went wrong. By subsequent calculations, we will be getting marks as far as you've clearly mentioned the steps and workings for the examiner to understand what you have done and how you have done that. Clear? Right. So that is question number 1. Now let's take a quick break, absorb what we've done in question number 1, then we'll proceed into question number 2. All right. So quickly absorb what we've done so far and be prepared to get into question number 2. I'll see you all shortly. Right, so with that, we're going to proceed to question 2. Again, what you're supposed to do here, there is professional skills marks that you're getting here. Okay, there is going to be professional skills marks. Open the requirement. Professional marks will be awarded in part A for the quality of the ethical discussion regarding Mr. Chan and implication for REFOCO. Now you're getting 2 extra marks for section A or requirement A, but that does not mean that you respond to other questions without applying professionalism. Because the professionalism that you show in your answers right from question 1 gives an indication to the examiner that yes, this candidate is up to the point, right? And this candidate has really done his work and really professional. So from that point onwards, you are creating the impression, right? So make sure all your answers are professionally written. But for this, we are specifically getting 2 professional skills marks, right, for exhibit A. Yeah. And or requirement A. Requirement B says using exhibit 2 in accordance with IFRS accounting standards. So that's an ethical implication. This is an accounting implication. Explain how the sale of medicines to the foreign government, including the outstanding receivables, should be accounted for in the financial statements for the year ended 31st December 20x7. Right? So that's what the question says. First, the ethical implications, and then there is an accounting implication which would require you to have a thorough knowledge about the standard in order to respond to that ethical implication based question. All right. So let's start with question number 2. Again, it's best that always you all copy these entire scenario, the questions, you copy them. You go to your word processor, you paste that here, right? And now you know how you need to answer, what you need to answer. Now here they are giving you 10 marks. 10 marks meaning good. Usually we say 1 mark for one well explained point. But if you are able to outstandingly explain your points and you are able to identify what the ethical issues are, you are able to identify what are the threats, right? What codes of conduct are being breached, what are the threats that are there, and what are the safeguards that you can take. The opinion of yours, how the person can take safeguards. If you can cover all those 3 in a proper clear format, clarity, and a proper structure, and fulfilling the requirement, applying the ethical principles knowledge based on the scenario and applying that here, would give you your professional skills marks. So if you're able to explain that well, even in 7 good well explained points, you will be able to score or secure the full marks. All right. Okay, so again, I would suggest and highly encourage that you all use this entire practice platform and always use the highlight feature that is given, right, when you want to highlight something. Now, for example, if you want to highlight multiple issues, you can highlight issue number 1 with yellow, then issue number 2, right? Likewise, you can just identify them and highlight them in different colors so that you know, okay, this is what something I want to use in my scenario, right? So use the highlight feature, use the calculator to calculate. If you want to calculate anything, you can always use the calculator, right? So you can use the calculator if you feel this is easier, or if you feel that no, you want to use the your calculator, you can take your calculator to the exam hall as well. All right. So 2 exhibits, make sure you use all the features that are given here properly. See, you go back, you can see the highlights, and once you highlight it properly, you will be able to understand, okay, this is what I am supposed to take into consideration. But remember, when it comes to exam setup, the highlight will not work in this way. Rather, it's going to dim. Now this dark black will become light gray when the highlight works. That's why when you enter this practice platform, they are giving you the instructions how things are going to look like in the real exam platform and how it is different here. So keep those in mind as well. Let's go back to the PDF. Okay. So I'll be using the PDF to, again, structure the answers. All right, question number 2. Referco is a health and pharmaceutical company which prepares financial statements using IFRS accounting standards. The financial year end is 31st December 20x7. Just highlight the date. Exhibits profit maximization is exhibit 1, profit maximization. Explains the ethical issues created by the implementation of profit maximization target. This is an ethical implication. Exhibit 2, medicine sales to foreign government, provides information about the sale of medicines to a government in another jurisdiction. So probably, let's just quickly run through exhibit 2. Okay, outside, so this is accounting. Selling sales of medicines. Accounting implication. Right? So exhibit requirement A says using exhibit 1. So you use only exhibit 1. Don't use exhibit 2 to answer this. Discuss the ethical issues raised by Mr. Chan's profit maximization targets. Whenever you are to read and to understand an ethical issue, you always should be able to recall all the codes of conduct, ethical codes of conduct that we are supposed to follow and bound by, right? So your response can revolve around this entire area. What are codes of conduct? So we have integrity, objectivity, confidentiality. There's the ACCA code of conduct as well. Professional competence and due care. As accountants, we are all supposed to follow these codes of conduct. Professional behavior. But there are instances when these codes of conduct are threatened, right? There are threats that threaten the codes of conduct, and because of those threats, we may not follow the codes of conduct and stay true here. So what are threats that we have? Self-interest threat, self-review threat, intimidation threat, familiarity threat, and advocacy threat. But this doesn't mean that you take all the threats that are not even relevant to the scenario. Don't do that. What's key here? Knowledge that is relevant and, most importantly, and can be applied to the scenario. Okay? Knowledge that is relevant and that can be applied to the scenario. That's what you have to do. That's what you have to focus on. You can't bring everything. Now, even if the scenario does not talk anything about confidentiality and you bring in confidentiality, explain that, no, that's not going to help you, right? Only what is relevant, bring that, explain what that means, and show it by applying how they are not staying true to that, right? And what are the threats? If the advocacy threat is not there, you cannot bring that advocacy threat in, right? You bring only the areas or the codes of conduct and threats that are relevant. Don't bring irrelevant items to the scenario just to spit your knowledge there. Don't do that. Okay, you're not going to get any scores. Rather, examiners would perceive you to be someone who is not very professional also, and you might end up not gaining any professional marks either. All right. Okay, so now as we read the scenario, we'll highlight whatever the issues have been identified. Okay. Referco is a health and pharmaceutical company. So we need to first identify what the industry is, meaning anything that's unethical to industry is also something. Now, all the ethical threats are going to be relevant to industries also, right? Which enjoys significant brand recognition and trust. Okay, so anything that threatens their brand reputation, recognition, and trust is also a problem. A new finance director, Mr. Chan, an ACCA member, an accountant, has been appointed, and his target is maximization of profit. First problem. Or rather than problem, threat. What's the threat here? Self-interest threat. We look at the first self-interest threat. What is self-interest? Maximizing profit is his target. We'll see how there will be something that he will be getting also to achieve the target. Let's see what that is as we read. The production director, Miss Finch, has told the board that there is a safety issue. Safety issue is there with the security seals on one of the medicines that Referco sells. Safety issue in one of the medicines regarding safety seals. Okay, looks like we have first issue that we are looking at. The cost of recalling the medicine would be $1 million. High cost. Miss Finch has planned to recall the medicine. Okay. Miss Finch, the production director, wants to recall. But the finance director, Mr. Chan, has blocked the plans. As he feels that it will affect the share price of the company. This is going to $1 million is going to reduce the profits. Maximizing of profit is his target. If the profit goes down, share price goes down, something is there that he is interested in. Let's see. Mr. Chan's view is that there is a very low risk to the public. Very low risk is Mr. Chan's view. Mr. Chan suggested to the board that if they wish to recall the medicine, they should buy it back using third parties in order to hide the issue and protect the company's reputation. Using third parties. Okay. Now we get something else also here. Integrity is missing. Okay, integrity is missing here, meaning they're trying to be dishonest. Mr. Chan has also instigated a cost-cutting program which will affect several medicines which are due to enter the market over the next few years. Cost-cutting program is the next problem I see. Several medicines which are due to enter the market over the next few years. Mr. Chan receives. There we go. Very, very important. Incentive. Again, self-interest. All right. Right? So integrity, in this case, even integrity is off, as well as he is not acting professionally either, right? Professional behavior is also jeopardized. Mr. Chan has decided that rather than invest in the research and development of new medicines, again, this will increase cost, research and development. So he's looking at everything that cuts the cost, which increases because he has a target there, which may never be approved, right? How does he know it's not going to be approved? If they don't invest in research and development, they will never be able to develop it properly. Referco should acquire companies currently holding medicine patents, meaning directly you can increase your profitability there. The principle behind this move is having bought these companies, Referco would hold the patents and raise the price of the medicine significantly. Very bad motive. So here, the problem, objectivity. Biased, right? There is objectivity issue because he is very biased and the motive is very unclean. Referco would overcharge for its medications in order to increase profits. Increasing profits is a target. Again, self-interest is what is getting him to do all of this. By manipulating market prices, Mr. Chan hopes that Referco may grow significantly as there is limited competition in the pharmaceutical industry because of strict regulation. Right. Now you see, not investing, not allowing to invest, not not maintaining honesty, not maintaining objectivity, right? Even having the slowest risk to the public, considering that it's not a problem of his, right? That shows that this person is not competent to be a director, right? Because there's no due care, there is no competence that is showing here, right? Strict regulation is also there, and despite that, he is trying to manipulate to increase profits. That is his objective. So professional competence and due care also plays a role here, right? But let's focus mainly on integrity, objectivity, professional behavior. Those are the three main codes of conduct that are being breached here. And the motive or the threat that is getting him to breach all these is the self-interest threat. Self-interest threat, right? What's the self-interest that he's having? Bonus of 1% of net profit, and maximizing profit is his target. Okay, so we've identified it. So we have identified what the codes of conduct are, what is the ethical threat that is there. Now we should look at what are the safeguards as well, right? Safeguards are also very important. If we don't bring in the safeguards, that's also going to be an issue, right? So we need to ensure that whatever Mr. Chan is doing correctly. And if we know that what Mr. Chan is not doing properly, we need to bring suggestions, right, to ensure that this person behaves, right? So how we are going to structure this answer? So we've identified, so what are the threats that we identified here? What's being breached? This is being breached. Objectivity is being breached. Professional behavior is being breached. Why? Because of self-interest threat. Is there an intimidation? No, there is no intimidation, right? Intimidation is where they try to force something, right? So coercing. So there's no intimidation. So self-interest threat. Okay. So now when you structure this answer, you have to apply. Now integrity, we know what are the points that are indicating that it is against integrity. So let's quickly highlight. Let's color code it quickly, right? Okay. Cost is 1 million. Ms. Finch has planned to recall the medicine, but the finance director has blocked the plans. Feel that it will affect the share price, right? This is number 1. So from scenario, how are you going to connect to your integrity? So integrity I'm highlighting in yellow. Right? And okay. Mr. Chan suggested to the board that if they wish to recall the medicine, they should buy it back using third parties in order to hide the issue. That's another integrity-based problem. So you always, when you're answering these types of questions, you always put a short, give small, when there's professional skills marks especially, you have to give some titles, right? So you give some topics and subtopics to break it down in that way. Okay. So you give each issue integrity, or if you want, you can even break this integrity issue down into two major issues. One issue is the medicine, right, safety issue. One issue is the cost cutting. So two issues, you can explain all the issues under those two also. Again, the way you structure depends on you. However you want to, you can structure, but make sure it is clearly demarcated. All right. Mr. Chan has also instigated a cost-cutting program that will affect several medicines which are due to enter the market over the next few years. Right? Now, what I've already read is the threat. Mr. Chan has decided that rather than invest in the research and development of new medicines which may never be approved, Referco should acquire companies currently holding medicine patents. The principle behind this move is having both these companies, Referco would hold the patents and raise the prices of the medicines significantly. Now, this is where objectivity comes in, right? This entire section indicates the issue with objectivity. Okay, that's the issue with objectivity. And then there is also there's also professional behavior and professional competence and professional behavior is what we're going to touch at, right? So this should buy back using third parties in order to hide the issue. Integrity is also there, as well as there is professional behavior that's not being shown. He's not behaving professionally as well. So I'm just highlighting professional behavior in blue. Okay, right. And then another integrity based issue that comes in, or objectivity. You can continue with the objectivity section itself. This entire part grows significantly. And all this is happening, we know, because of the incentive, that is self-interest threat due to 1% of net profit, where growth is very important. Now, when you're responding to these, you highlight these and show how first you say what is integrity and why there is a need of Mr. Chan being an ACCA member and accountant to maintain integrity, right? And how he is not abiding by it, right? Not abiding by integrity, where he is blocking the plans as he feels it'll affect the share price. When the share price is affected, that's going to impact the profits, which is his target of profit maximization, because he has an incentive of that is 1% of net profit, which is causing a self-interest threat to him, which is why he is not acting with integrity, right? Next one, buy it back using third party. He's not behaving professionally because one, the integrity, not being honest and trying to manipulate, and two, behaving very unprofessionally and buying back using third parties, which if caught would cause reputational damage to the company, and would, now since the safety issue is there, security seals are damaged, anyway that is going to come into light, right? When it comes into light, that's going to cause more harm than good, and the cost is going to increase much more than $1 million. So that explanation is needed there, right? Then the cost cutting program affecting several medicines which are due to enter the market, right? And not investing in research and development. Those two are other issues which shows that his professional behavior is out, right? His professional behavior is out, right? Cost cutting program is instigated and decided not to invest, rather acquire the patents. So this shows that he is not acting professionally, or he's not behaving professionally, because his target is only on profits. If they continue to invest in research and development, that is going to be better for public, and future reputation also becomes better, and they'll be able to come up with their own medicine patents. They would be able to create their own medicines and develop their own medicines, which would be impacting them positively and even the public, right? And cost cutting program which will affect several medicines is also going to threaten the public again, right? There's a risk to public if they cost cut, and that's going to impact the medicine, because medicine, you can't play with that. It's playing with people's lives, right? So again, professional behavior, you can bring those points in, okay? And the principle, then you can explain the entire area, the entire part of the objectivity not being made. Objectivity meaning being unbiased is objectivity, but here he's being biased. He's being biased towards company's growth. He's being biased towards maximizing profits. He's being biased towards increasing the prices for the company. Why? Because that he has a benefit, that he has self-interest at the end of the day by doing that, right? Increasing profits by overcharging the medicine, increasing the medicine prices, again that's going to impact the public. So general public is being impacted by overprice, by the substandard medicines, or safety, that medicines are not safe, impacts public. Then the medicines that are due to enter the market, cost cutting impacting them, again the general public's lives at risk. And not investing in research and development, meaning they would not be able to develop further medicines, right? So this entire section you need to discuss in depth, bring clarity to your discussion, and ensure you mention all the points that are impacting whatever the codes of conduct are. And what is the underlying threat? That's the profit maximization, 1% of net profit based bonus. Okay, that is what is getting Mr. Chan to do all this, and not any good or clean motives. All right. Okay, so he as an account also need to ensure that whatever motives are, it should be of a positive good, which in this case is causing more harm than good. Okay, so that's how you explain. Now here there is no need of bringing in, so what they are saying, ethical issues raised by Mr. Chan's profit maximization targets. Ethical issues. What are the issues? So you're not supposed to give them a suggestion. So here, since they are not asking you to, tell what you would be doing now, since you are not getting into anyone's shoes, and you are just looking at from a third party, you just have to say what are the issues and why it's an issue, why it's a problem. So that would be a good way to respond to this question. Okay, that's exhibit 1. Then exhibit 2, Referco sells medicines to a government in a different jurisdiction but has experienced significant delay in receiving payment. Sells medicines. Okay, sells medicines to a government in a different jurisdiction but has experienced significant delay in receiving payment. Currently, it has outstanding receivables outstanding of 3 million, with some of the amount being 4 years overdue, long overdue. However, Referco has continued to sell medicines to the government at its normal market price. The medicines are essential in fighting disease in that country, essential medicines. Referco attempted to renegotiate the prepayment terms and stated that they would accept consideration below the contract price. There's a price concession. There's a concessionary price that they're bringing in. By 31st December, no agreement had been reached. Both parties accept that Referco has an unconditional right to receive payment. There is an unconditional right to receive payment. Okay. So what are standards that are impacted here? First, we have to identify what are the standards. Selling medicines and not receiving money. So first standard that's applicable here is IFRS revenue with contracts from customer. Then there is IFRS 9. Why? This receivable is a financial asset. Right? These are the two standards that are being impacted. Okay? So when you have these two standards, you need to identify what are the issues with this standard. Right? Now, when it comes to the new sales, as per IFRS 15, can they make the new sales while there is outstanding? Right? And they know that they have unconditional right to receive payment and they are sure that they are going to receive the payment. But the receivable is outstanding for a very long period, right? There is a very long period of receivable outstanding. So what will you be doing there? Okay, right. Now in this case, this outstanding of 3 million, there are two ways. Now when the future, now past sales, now future they're continuing to do the sales. Now in future they can decide whether they are going to discount the sales. Now anyway they know 4 years, so 4 years is a longer period, so there is going to be deferred consideration, right? Deferred amount that you're going to receive. Okay, so here first you know that the client's ability or intention to pay, it's a government, right? So let's say you can assume that you are going to get the money, but how quickly you are going to get, because you still have not got it in the last 4 years, right? So if you are making new sales, you need to make a call whether you are going to discount it at present value, right? Initial recognition of payment, will that need to be discounted, right? So I'll just bring the points in. Okay, so exhibit 2, there's IFRS 15. You can quickly bring a short knowledge here. Knowledge. How? By bringing in definitions of contract, right? And how the sales is a contract between the government and Referco. right? Why there is a contractual, there is a right to receive cash, right? Then there is the contract has commercial substance, and the payment terms can be identified, right? The each party's rights relation to goods should be identified. The contract has been approved by the parties, right? And the consideration is to be received. All those conditions are being met. Therefore, you can say it is coming under the purview of IFRS 15. It's a contract, right? Then you should say, as per IFRS 15 may require you to consider deferred consideration and variable consideration. Those two are important here. Deferred consideration due to the timing, which is 4 years outstanding, still they are continuing to do. So deferred consideration, will that be coming in? Concessionary payment, they are going to reduce it. So that's the variable consideration. Concessionary. Right? So this is the consideration becomes variable. Okay? So you have to bring that how concessionary payment makes the consideration variable. Okay? Now, when you are looking at the receivable, now that's IFRS 15, right? Then IFRS 9 component is there. So IFRS 9 receivable. You have to decide whether you are going to consider deferred consideration, variable consideration component and recalculate and remeasure things there, or you are going to consider it as impaired financial asset as per IFRS 9. Right? Whether you are going to consider it as impaired financial asset as per IFRS 9. Right? Now, when it's a slow payment does not mean that it is not a revenue recognition. You can recognize the revenue, right? Payment is separate to it. Now, payment is going to depend on IFRS 9 whether now receivable being a financial asset as per IFRS 9 instruments, when there is an outstanding, it needs to be impaired. So there should be a loss allowance. And the standard IFRS 9 simplifies for receivables that loss allowance should be at the lifetime expected loss allowance, right? Lifetime expected credit losses. Right? Now, how would the lifetime expected credit losses come in? So that is going to be the estimate of the amounts that the entity is expecting to receive right? So you have to always look at the estimate of the amount that the entity is expecting to receive against the invoiced amount or the transaction amount. The difference is, of course, the credit impairment, right? That if there's a difference, that means that it is credit impaired. Okay? So when measuring lifetime credit losses, make sure you have to look at the estimated receipts, right? Whatever you are estimating that you are going to receive, right? What you are going to expect to receive in the future, considering the deferred and the variable payments, right? You consider discounting factor and you look at what the customer's credit risk, government's credit risk, you have to, look at based on what sort of government they are, and the credit impairment needs to be done, right? So what would be the calculation? Calculation is going to be the carrying amount of receivables and the present value of expected future cash flow. right? That is going to be the credit loss. Okay, so that is going to be the credit loss. So those are two standards that are applicable here. So when there is deferred consideration, meaning you are doing the present value of expected future cash flows. Variable consideration due to concession repayment, meaning you are reducing the repayment amount from the initial value. So that's a variable consideration. So you have to do that estimate. And the IFRS 9 is applicable because receivable, once it is, now you can recognize the revenue, but receivable, once it becomes a receivable, it falls under financial assets purview. And when it's financial asset, that is overdue, it is impaired financial asset, whereby you have to do a loss allowance, where IFRS 9 allows a simplified loss allowance approach where you can bring in lifetime expected credit losses instead of 12 months. So for receivables, you can do lifetime, which is going to be estimate of the amount that the entity is expecting to receive against the invoiced amount, right, which is credit impairment. So how do you calculate that? Carrying amount of receivables, and you deduct your present value of expected future cash flows from that carrying amount. Okay, so in that way you will be able to respond to question number 2. Okay, in that way you'll be able to respond to question number. I've not given the question number 2 response in detail, but I've given you all a guideline as to how you are going to face these questions and what are the standards that are relevant. So when you understand, when you remember all the standards, you definitely will know the standards in and out. And when you know standards in and out, you can respond to the questions accordingly. Right? So that is question number 2. So now what we'll do is question number 3, we'll try to do that, but we'll take a short break, come back, and we'll do question number 3, and we'll see if we are in a position to do question number 4 as well. Okay, so let's take a short break and come back. All right, guys. So let's move to question number 3. Jared Co. Right. Jared Co. prepares financial statements in accordance with IFRS accounting standards. The financial year end is 31st March 20x3. The following exhibits, 2 exhibits again. There is exhibit number 1, which is server contract. Explains a contract that Jared Co. entered into with Servicio Co. on 1st of April 20x2 to install a server. Then cryptocurrency describes the purchase of cryptocurrency by Jared Co. on 1st January 20x3 and how directors are considering measuring it. Right, okay. Now for this, a quick tip to you all. Cryptocurrency, there is a technical article that I would encourage you all to read. All right. So exhibit 1 is server contract. Exhibit 2 is cryptocurrency. Right. So what are the requirements? As I always say, copy the requirements, paste it, then you start answering accordingly. Using exhibit 1, here you're supposed to use exhibit 1, explain in accordance with IFRS 16 leases why the server contract contains a lease. Why is that a lease? So for this, you have to bring in knowledge of the standard. Explain with calculations how to measure the carrying amount of the rights of use asset. Explain, calculate. How to measure the rights of use and corresponding lease liability in financial statements of Jared Co. as of 31st March 20x3. When did they get into the lease? On 1st of April. You're supposed to bring in 31st of March. So remember, you're supposed to bring initial measurement as well as subsequent measurement. Why? The initial measurement is at the start of the year or start of the contract, and subsequent measurement is you do at the end of the year. All right, so right of use asset, you have to do the depreciation and you reduce the carrying amount. Lease liability increases by the finance cost and reduces by the payments. That's the basic understanding you need to have. Right? That's using exhibit number 1. B1. It discusses the reasons why cryptocurrency may not meet the definition of cash or cash equivalents or that of a financial asset, but may meet the definition of an intangible asset. Okay, now this is a general question. They're not asking you to refer to an exhibit. They're saying there's no need to refer to a specific exhibit to answer part B1. 7 marks. So what are they saying? You need to explain why it may not meet the definition of cash or cash equivalents, IA 7, and that of financial asset, IFRS 9, why it does not meet that, and you have to say but may meet the definition of intangible asset. So they are clearly saying that when they are saying IAS 7, IFRS 9, it cannot meet, you can't say that no, it meets. Right, now you have to support saying that yes, it does not meet and it meets IAS 38. You can't go and say that no, it does not meet IAS 38, but it meets IFRS 9 or IAS 7. You can't say that, right? You have to explain why it does not meet IAS 7 and IFRS 9 criteria and why it meets IAS 38 criteria. General response there. Again, applying knowledge. If you had read the technical article, and even if you now in the exam, I don't think they'll give this question since they've given it in mock, but this is an indication that sometimes reading technical article is very important. What if in exam they ask you about crowdfunding, right? Why? What happens in crowdfunding and how is it relevant to IFRS 16, IFRS 15, IFRS 9? How is it going to deal with crowdfunding? Is going to deal with these separate standards? If they ask you that, there is a technical article already explaining to you about that. If you read that and go, you will be getting easy marks there. Had you read the cryptocurrency technical article before doing this mock paper, this would have been an easy mark for you. Okay, because they are clearly explaining all these, right? Let me just quickly take you all to that technical article, right? SBR technical articles. So all this, that's why reading technical article is very, very important. Okay, cryptocurrencies. There is a separate technical article on that. Right, so what is cryptocurrency? They are explaining that at first it might appear that cryptocurrency should be accounted for as cash because it's a form of digital money. However, cryptocurrencies cannot be considered equivalent to cash as defined in IAS 37. So they're clearly explaining all that you are supposed to respond there, because they cannot readily be exchanged for any good or service, although an increasing number of entities are accepting digital currency as payment. So you know what to take. So IAS 7 defines cash equivalents as short-term, highly liquid investment that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. You bring that definition there and you say thus cryptocurrency cannot be classified as cash equivalents because they are subject to significant price volatility. There is no insignificant risk. Okay, therefore it does not appear that cryptocurrencies represent cash or cash equivalent. See, it's just you derive the answer from this technical article itself, right? I don't even need to go and draft the answer there, right? So first you break it down, IAS 7, you define what cash and cash equivalent is, and you say apply why it does not meet, cryptocurrencies does not meet that criteria. IFRS 9, financial asset, you define that meaning knowledge, then you apply to a scenario why cryptocurrency does not apply to the definition of financial asset as per IFRS 9. Okay, intuitively it might appear that cryptocurrency should be accounted for as financial asset in accordance with IFRS 9. However, it does not seem to meet the definition of financial instrument either, because it does not represent cash and equity interest in an entity or a contract establishing a right or obligation to deliver or receive cash or another financial instrument. Cryptocurrency is not a debt security or nor an equity security because it does not represent an ownership interest in an entity. Therefore, it appears cryptocurrency should not be accounted for as financial asset. Clear? There you have the answer. Define IFRS 9 financial asset. Then you have to prove why cryptocurrency does not, which section of the definition is not met by cryptocurrency. Therefore, this is not met. Then they, however, do appear to meet the definition of an intangible asset in accordance with IAS 30 intangible assets. Exactly the technical article. This is exactly the question has been technical article. So keep an eye, very important to keep an eye on technical article section. Very, very important. All the technical articles that are there, understand, absorb, make notes. And especially the technical article that is released closer to the exam date, definitely there's going to be something relevant to that. So just keep an eye. Okay, you would know whether it is a technical article close to exam date or it was released before only if you keep an eye throughout. Otherwise, you would not know which is new and which is not. Okay. So this standard defines an intangible asset as identifiable non-monetary asset without physical substance, giving definition of intangible asset. IAS 38 states that an asset is identifiable if it is separable or arises from contractual or other legal rights. An asset is separable if it is capable of being separated or divided from the entity and sold, transferred, licensed, or rented or exchanged. Right? So there is a big definition here. Go down. Thus, it appears that cryptocurrency meets the definition of intangible asset in IAS 30. It is capable of being separated from the holder and sold or transferred individually. And in accordance with IAS 21, it does not give the holder a right to receive a fixed or determinable number of units of currency. Right? Then you have to explain if it is meeting IAS 30 definition, how would you deal with it? What's going to be the measurement? So this section, IAS 38 allows intangible assets to be measured at cost or evaluation. Using the cost model, intangible assets are measured at cost on initial recognition. So it's all theory. Right? So summary of this technical article should be your answer there. Right? And when you are saying it's IAS 38, you need to explain how will you account it using IAS 38. Okay? So we've already discussed the B1. Right? 7 marks. So let me quickly structure the answer also for you so that you can make a note of it. So this is where I am responding to B1 because that's something that we can immediately get into. Right? First, you have to prove why not IAS 7 cash and cash equivalent or IFRS 9 financial asset, right? So there you bring IAS 7 definition of cash and cash equivalent. Then you apply to cryptocurrency price volatility is the main reason why it does not volatility. Okay, then you have to bring the knowledge of IFRS 9 definition of financial asset, apply to cryptocurrency, no contractual rights is the reason why it does not meet. Then you bring IAS 38 definition of intangible asset, apply to cryptocurrency, meets most of the definition. Then you have to also mention how can use cost or revaluation model to account for cryptocurrencies. So in this way, structuring your answer would get you marks. Okay. Right, then B2 says using exhibit 2. Now we are supposed to use exhibit 2. Discuss the steps that Jared Co should take to measure the fair value of cryptocurrency. You're measuring fair value in accordance with IFRS 13. Now you need to have IFRS 13 knowledge also. Briefly explain the impact of fair value measurement on Jared Co's financial statements as well. Impact meaning calculation, right? What's the actual value? What was the recalculated value, and how that's going to impact? So you see, second question has so many standards that you have to deal with. Yeah. So what were standards? IFRS 16, IFRS 9, IAS 7, IAS 38, IFRS 13. Okay. Question number 1. We dealt with question number 2, what was standards we dealt with? IFRS 15, IFRS 9. Then question number 1, IFRS 3, IFRS 10, IAS 12 was there, deferred tax was there, what else was there? Yeah, IAS 12. Was there anything else there in question number 1? Yeah, it was mainly the group accounting and IAS 12, right? Components of group accounting was there. So you see how many standards are already covered in questions until question 3 itself. So let's quickly look at question 4 also and see what are standards being covered. So you can at least revise those standards today. IAS 37. Goodwill. Restructure. Employee benefits. When they say benefit, I'm assuming it's employee benefits, right? Employee who leaves, employee benefit is also there. So IAS 37. IAS 19. So even in case we're not able to cover this question today, you have the standard that you can refer to and make yourself comfortable and familiar with. Okay, right. So now let's quickly draft, or let's quickly Canva skeletal answer for requirement A. Right? So requirement A is using exhibit 1. First you have to explain the IFRS 16 leases, right? Server contract is a lease is what you have to explain. Server contract should be your topic and this should be your target, right? Then you bring in the lease definition, right? This is lease is a contract that conveys the rights to use an identifiable asset, right, in exchange for consideration. That's the knowledge part. Okay. Okay, still we are going ahead with knowledge, so I'll continue with purple since we've maintained that color coding. Right. Now you have to explain, right? Now you have to explain why right to control exists. Right to control, the knowledge says, or the IFRS 16 says, right to control is when all risks and rewards, economic benefits from using the asset can be derived, right? Then should be able to direct the use, meaning determine how and when the asset is used. So still I am bringing the asset, the definitions only, right? Identifiable asset. So if you explain through these criteria, you can prove whether it is going to be a lease or not. So why you're here supposed to do a lease, whether it meets lease or not, that's what you're supposed to explain, right? So identifiable, explicitly identified in the contract, right? And supplier has no rights substantive to substitute the asset, right? What does it mean? Supplier can't replace the asset, but can substitute for repairs or maintenance, right? Can't replace the asset but can substitute for repairs and maintenance. So that is what shows the supplier has no substantive rights. Now this is the knowledge. Now let's see how we can apply that to scenario. Let's go back to the scenario. Let's read that. On 1st of April 2022, Jared Co. entered into a 5-year contract. Okay, that's a 5-year contract with Servicio Co. for digital services. Under the agreement, Servicio Co. installed a hardware-based server physical device, which manages access in a computer network at Jared Co.'s head office for the duration of the contract. Access management is at Jared Co.'s head office. The server is explicitly identified in the contract, and Servicio Co. can only change the server if it stops working, malfunction. So that brings us the identifiable. Okay, we can apply that directly. So it shows server explicit identified. I'm not going to draft full answer. I've given you all knowledge, then you all support the application below that. So I'm just identifying what are there, right? And it says it can't replace unless malfunctioned. No substantive rights. So it's clear that it's an identifiable asset that we are clear about, right? Jared.Co controls the data which is stored on the server and has integrated server into its operations. Jared.Co controls the data. ServiceCo maintains the server and provides data backup and software upgrades. Data backup, maintains, right? Maintenance, data backup, software upgrades. But ServiceCo cannot determine how the server is used during the term of the contract, nor can it decide whether to modify a server or use it for another purpose, right? So here you can also say ServiceCo provides maintenance and upgrades services, which is not substantive right. Right. As ServiceCo, okay, substantive, let's write it up to this point. Control the use. We can see that ServiceCo does not control, does not direct the use. Instead, alright, so ServiceCo does not. Instead, Jared.Co is the one who controls. Why they are saying Jared.Co controls the data, right? Jared controls the data. That also they've clearly mentioned, right? ServiceCo doesn't direct the use. Instead, Jared controls the use, right? So they are saying clearly saying right to control, and they are even the access. Also, the access control also is with Jared.Co's at Jared.Co's head office with Jared.Co. Okay, so that part is clear. Now, considering all of this, it is for a period of time as well, right? So the contract is for a period of time, so it's mating the definition, right? And it's for a consideration. This is a consideration area, right? So the legal title remaining with server does not matter. The ServiceCo having the legal title does not matter. Substance over form is what legal mainly focus on. Jared pays the insurance and maintenance of server separately from the annual payments. So there's a separate payment that Jared does for insurance and maintenance also. Therefore, now you can say, like, you can give that knowledge part, you can explain the definition, give all the definition, and then you can say, therefore, this contract contains a lease and Jared.Co is the lessee, should apply lessee accounting, according to which a rights of use asset and a lease liability will need to be recognized in Jared.Co's financial statements. There we go. So we explained, we put ServiceCo as a topic, gave the knowledge, we applied it to a scenario, and therefore this contract contains a lease and Jared.Co is the lessee and should apply lessee accounting, according to which a rights of use asset and a lease liability will need to be recognized in Jared's financial statements. Clear? Then the next requirement says explain with calculations how to measure the carrying amount of rights of use asset and the corresponding lease liability in the financial statements of Jared Co. as at 31st March 20x3. Explain with calculations. Number is important here. Calculation is important here. We need to show them what is going to be the initial measurement, what's going to be subsequent measurement. So now we can break this response down under two sections. Right of use asset or let's start with lease liability because we'll need lease liability value for right of use assets. So let's bring lease liability on top. Lease liability and right of use asset. You bring lease liability and right of use asset. Okay. Then now you have to explain knowledge as per IFRS 16. The lease liability is measured initially at present value of fixed payments, right? Present value of fixed lease payments, right? Fixed lease payments. So then now you can actually, and subsequently, you quickly bring that knowledge part, and subsequently, the lease liability will increase by the finance cost and decrease or reduce by the payments made. Knowledge. Now you apply, right? Jared Co. has agreed to make fixed payments of 1.05 per year throughout the lease period. Okay, now fixed lease payment also considers a fixed installment plus it deducts the incentives also. Huh? Now there is an incentive here as well. Period. So let's quickly do the calculation here. How will the calculation work? Go back to the scenario. We need to read that part. There are 5 annual payments. 5 annual payments to be paid under the contract of 1.05 in advance, meaning one you already paid before at the lease commencement, so that does not fall under your lease liability. Where does it fall? That would be a part of your right of use asset. Lease liability considers 4 payments. Had it been in arrears, then all 5 payments will be considered. Here, since it's in advance, we just consider 4 lease payments. Jared Co. will receive cash back of 525 on the first anniversary of the contract. First anniversary meaning after 1 year. right? After 1 year, meaning you have to discount that also, remember. There were direct legal cost of 100,000 paid by Jared Co. Legal cost, where will that come? Direct cost is a part of right of use asset. The fair value of server is 5 million on 1st of April 2022, and the interest rate implicit in the contract is 5% per annum. Fair value of server is 5 million on 1st of April 2022, and the interest rate implicit in the contract is 5%. So we are using 5% to discount. The cumulative present value of one discount rate at 5% for 4 years is 3.546. They've given the value of $1, right? It's going to be 3.546 in 4 years time, right? Let's quickly, now we are in a position to measure that, right? We are in a position to measure that. Again, initial measurement, we split that as initial and subsequent. Fixed payments, $1.05 into 3.546, right? That's a fixed payment. So that is going to be how much? That's going to be how much? That will be 3.72 million. Right? That's 3.72. 1.05. Let's do a quick calculation. Let me use the calculator. 1.05 into 3.546. Yeah, 3.72. Rounding it off. Right. Now there's an incentive, right, which you need to deduct. Minus incentive from lessor. How much is the incentive? Incentive is 525,000 in 1 year's time. So you have to discount that using 5% as well. 525,000 into 1.1 divided by 1.05 to the power 1, right? 525,000 into 1 over 1.05. So that will be 500,000 or 0.5 million. Deduct that. Okay, so what's going to be the lease liability? Lease liability, therefore, will be 3.22 million. Okay, that's your lease liability. Then we come with a subsequent measurement. Subsequent measurement at the end of year 1, since we want it as at the end of 31st of December. Subsequent measurement at the end of year 1. Since we've already made the payment in the beginning, 31st of, is it December, March? The date is 31st March. So we'll be making next payment on 1st of April. So the 31st March, we've already deducted that payment in the beginning. So 31st of March, we're not deducting any payment there. So we use the amortized cost table. So amortized cost table. Usually how is the amortized cost table? Amortized cost table will have a brought forward amount, right? You have the brought forward amount. And along with that, there need advance, you'll have the cash payments. But here there is no any cash payments, right? Then there is going to be interest, finance cost. That will give us a carried forward liability. Okay? 31st of March X3. Brought forward amount was 3.22 million. This we are bringing from here, 3.22. Cash payments, no cash payments because we've already made the payment in the beginning. We are making next payment only on 1st of April, so we're not considering it here. 3.22 into 5%. Right, so that's going to be how much? 3.22 into 5. 22 into 5% will be 0.16 million, and your liability will increase by that amount. So your closing liability will be 3.38 million. Okay, that's going to be your closing liability. Now this you are supposed to do on Excel, or you are supposed to do it on the practice platform, but since I'm showing you the structure, I'm doing it here. Okay, right. Then we go into right of use asset. Again, you bring in the knowledge component here. Right of use asset will be measured at cost, which includes present value, or rather than putting that in that way, lease liability plus any advance payments plus any direct costs. Right? Now we have to apply to the scenario. Right, so here you bring in lease liability of Jared Co. calculated on 1st of April. X2 was 3.22 million, as well as 1.05 million paid as the first installment in advance. In advance needs to be considered along with direct cost, legal cost incurred of 100. Go back to scenario. What's the direct legal cost? Direct legal cost of 100,000, right? 100,000. So useful life is 5 years. No residual value, that's not relevant. So useful life is important for depreciation, subsequent measurement. Okay, of 100K. All right. Initial measurement, or you bring in the knowledge of subsequent measurement, then you do the knowledge subsequent measurement reduce the carrying amount by the annual depreciation, which would be done over the shorter of lease term and useful life in the case of ownership not being transferred. That's the case here, right? Not being transferred, which is 5 years as lease term equals useful life. We use 5 years there. Okay, that's a subsequent measurement. Then we quickly do the treatment. Initial measurement. lease liability, payment in advance, direct cost. Lease liability has been 3.22. Payment in advance has been 1.05 and 0.1 has been the direct cost. Okay, 0.1 has been the direct legal cost. That brings us to a total initial measurement of 4.37 million of asset. Depreciation subsequent. So you all don't need to show it separately. You can do it in this itself. Below that you depreciate, but here I'm showing it for your clarity, right? Is going to be cost over the number of years. In this case, I'm not mentioning useful life lease term because we know it's shorter, which in this case is 4.37 over 5 years. That is 0.87 million. Right? Now you quickly will have to show the presentation. SFP as at 31st of March X3, right? There we are going to have a lease liability as non-current, or PPE, right? So right of use asset under asset section. The carrying amount of how much? 4.37 minus 0. So that is 3.5 million. And liability, we split that as current and non-current. Lease liability at the end of the period. We have done the amortized cost table, 3.38 million. 3.38 million. Okay. And then the SPL, right? SPL, we will be showing finance cost and depreciation for the year. Depreciation for the year is 0.87 million and finance cost for the year is 0.16 million. At the end, once you have the profit or loss, that will be transferring to your SFP. In that case, this will also be recognized in SFP, right, in your retained earnings. Okay, so that is our subsequent measurement, subsequent treatment. So you can do this subsequent measurement as working also. Okay, you can show it as working also. That is the answer for this question. So always you bring in knowledge, you know how to bring in knowledge, how to support it in application, and how you are going to show the workings also. So all that I have given you all a clarity, right? A clarity in how to approach questions and how to bring in answers, right? So with that, we are done with the first requirement completely. B1 also we are done with. Now we have to do B2. B2. Discuss the steps that Jared Co. should take to measure the fair value of IFRS 13. So here now B2. IFRS 13. So now in this case, again, you have to bring the knowledge, right? Bringing knowledge is the key here. So in bringing knowledge, you have to bring the definition of IFRS 13, right? So remember, when you take IAS 38, it allows to use revaluation model. Now we are using IAS 30 for cryptocurrency, It allows the revaluation model only when active market exists, right? So you have to quickly bring that point in here. IAS 38, revaluation model. That's when you lead fair value, right? Model only when active market exists. Right? IAS 38 says revaluation model only when active market exists. And when there is active market, you will be using IFRS 13 to measure fair value. Right? So, bring in a quick definition of fair value. Then you bring in the hierarchy. So what's the hierarchy? Level 1, level 2, level 3. Quoted price. This is all knowledge, standard. In active market for identical asset. Then there's observable inputs. The level 2 input is observable inputs. Level 3 is unobservable inputs. I'm sure you know what these are. I don't need to take you all in detail. Right? So IFRS 13 always gives precedence to observable inputs over unobservable inputs. Right? Okay. Now first, you have to determine, in this case, application. Determine whether an active market exists. What's an active market? Where the transaction, the frequency and volume are high. That's active market. Right? That's active market. Okay? Now, when there is an active market, right? So here there are several markets that they've provided here, right? They've provided several markets here. Market A, B, C, D, E. Okay? So when each market, now there are active market, when there are different rates provided, different frequencies provided, in this case, now you have to identify or determine the principal market. Principal market, right? The principal market is the market with greatest volume and level of activity. Right? So principal market is the market with greatest volume or activity. Okay? Right. Now let's quickly go and have a look at the markets that they've provided here. All right. So they've given some information because the auditors do not believe the crypto means the difference of cash or cash or that of financial asset. IAS 30. They're mentioning clearly, and revaluation model. On 1st January, Jaredco purchased 1,000 units, 6,500 per unit. This will be needed for impact. The cryptocurrency is traded in several markets with different prices being quoted in each market, as there is no single price for the cryptocurrency. Markets are volatile, and Jared cannot access every market as some markets have restrictions. So let's quickly look at what are the markets with restrictions. Allows trading for values less than 10,000. Right? Trading crypto needs license which can only be obtained by financial institutions. Trading in the cryptocurrencies on the derivatives market and is not subject to specific regulation. Trading, these C and D restrictions are not there. Although there is no direct ban on the trading of the cryptocurrency, there are very strict rules which makes trading in cryptocurrency a difficult process, right? Which is why it's clear C and D are the, now A, B and E can be eliminated because there are restrictions there, right? You are restricted there, right? So now what you have to do is you have to look at the market with no restrictions and with highest level of activity. Okay. Now in this case, there are two markets, right? There are two markets, C and D. 6,300, 6,350. Transactions per day is also high. Market size also. It's very similar, right? Now in this case, identifying principal market becomes a little difficult, right? So there we are able to determine there's no clear principal market, right? In this case, no clear principal market, right? So when there is no clear principal market, you have to determine, so here you have to have IFRS 13 full understanding, okay, full knowledge. Determine the most advantageous market. Right? So this is the active market with highest activity levels that an entity has access to, meaning no restrictions. Right? So considering here, we have to explain that A, B, E removed, C and D remain. Out of C and D, now we have to select which is the most advantageous market. Right? And now when we go back, we can understand that the most advantageous market in this case, although not principal market, is where the price is high. Okay, 6,350. So which is why this becomes the most advantageous market, right? Therefore, most advantageous market is market D. And finally, you have to measure the fair value of cryptocurrency using market D, which is 6,350 per unit, right? So now we move to impact on financial statements. Impact on financial statements, right? So impact, how to look at the impact? What is the new value? What's the fair value? Fair value at the year end is going to be 6,350 into the 1,000 units that they hold. That's going to be 6.35 million, right? 6,350 into 1,000, right? So that's 6.35 million. 6.35 million. But what was the initial recognition or previously measured at? Previous measurement was 6,500 into 1,000 units, right? Right, so that was 6.5 million. Therefore, the difference is 6.5 minus 6.35, or you do it in the other way, 6.35 minus 6.5. 6.35 minus 6.5. You know that there is a revaluation loss of how much? 150,000. And this will be recognized in your statement of profit or loss. That is the impact on financial statements. Okay, that's the impact on financial statements. So in that way, you should be able to answer this requirement as well. Clear? All right, so with that, we have responded to all the requirements of question 3 as well. So we're done with question 1, we're done with question 2, we're done with question 3. Let's quickly run through what we've done so far. Question 1 done. Question 1, all the issues. Now you should have the hang of how to bring in knowledge, how to bring in application, how to bring in the calculation elements. Right? Question 2 done. Question 3 also has been done. B1 was the technical article itself. So read technical articles, very important. And quick tips for you before we wind up today's lectures or today's discussion. We might or might not be getting a chance to discuss the 4th question. Let's see how we can proceed there. But we know what the standards are, IS 37 and IS 19. Right, so just read those standards. And the quick tips that I want to give you is don't calculate total in pre-populated spreadsheet. Reiterating what I told. Follow the knowledge plus application plus calculation or correction. Right? Calculation or correction. Use a KAC approach. When there are professional skill marks, skills marks, you have to ensure clarity, structure, and relevance. Right? Ensure clarity, structure, relevance. Most importantly, time management is key. And especially question number 1, do pre-populated spreadsheet alongside other exhibits or requirements. Okay? Read technical articles, examiner reports, practice past papers, specimen exam, and practice exam on practice platform. Remember the details of all the standards and cover 100% syllabus. If time permits, use Kaplan revision kit plus study hub of ACCA practice questions. All right, so that's the tip for y'all, and wishing you all the very best. Don't hesitate to get in touch if you have any doubts, any understanding that you want to gain from me. You can always reach out to me at this contact number, right? All right, guys. So do reach out to me if at all, if ever y'all get any doubts, any questions throughout the next couple of days. I'll try to assist y'all to respond to those questions and clarify your doubts. Wishing you all the very best and looking forward to seeing y'all gaining flying colors. If you remember the tips, if you practice well, you are going to definitely get through. 50 marks is not impossible. All right, all the very best once again. With that, I conclude the pre-March 2025 mock paper discussion of question 1, question 2, question 3 of SBR. And if time permits, I'll see you all back with question number 4. In case time does not permit and if I'm not able to be here to explain to you all or take you all through question number 4, you all know the standards. Please refer through the standards and be particularly ready with all those standards. All the best.